Let's talk about power now on Power Lunch. This is the type of deal, one we're going to describe now, the type of deal I think we're going to see a lot more of. Let me just give you the introduction. Vantage Risk Capital, which is Africa's leading mezzanine debt provider, today announced it had concluded a transaction with Genser Energy Ghana to provide up to $30 million US, that's approximately 280 million South African rand, of expansion capital to the company. Most of the initial funds, it says, will go towards the completion of the Chirano power plant in the western region of Ghana, as well as the funding of a natural gas commercialisation project. To talk more about the deal now in the Johannesburg Power Lunch studio is Luke Albinski, who is managing partner at Vantage. Well done on the deal, first of all, Luke. Can you tell us a bit more?
Yes, no, we're very excited about this deal. It's actually our first deal north of the Zambezi, in the sense that last year we did a deal with PSG to buy a business called CA Sales in Botswana, but this is our first deal in West Africa. And we looked, Lindsay, at about 80 different investment opportunities before selecting this one, due diligencing it and concluding it yesterday.
Tell us about mezzanine and where it fits into Africa. Is this a sort of deal that is going to become more prevalent, as I suggested in my introduction? Is it appropriate for African economies?
I think so. Mezzanine, as you know, is that intermediate stage of capital between senior debt and equity. And in this particular case, what we were dealing with here in Genser was a family business. The family didn't want to let go of the equity. It is a business at a very, very sharp growth trajectory, on a very sharp growth trajectory. And so mezzanine, which is not as dilutive as equity, seemed to be the best option for them.
Genser, is Genser going to plug into the national grid in Ghana, or is this going to be specifically for providing the needs of, for example, mining and large-scale industry?
So Genser is what one calls a distributed power producer. So it embeds its power plants on the sites of major corporate clients, such as Unilever in the port city of Tema, or with Kinross Gold Mine in Chirano. But excess power over and above the needs of these large industrial and mining clients will be led into the grid and will help with Ghana's crippling power situation right now.
Yeah, I was going to come to that actually. I mean, how crippling is it? I know that Ghana has grown very, very quickly because of its natural resources. It seems to me you could double or triple the amount of power that's available and you'd still be in trouble.
Absolutely. I mean, if one looks at the stats, Ghana's electricity usage is 1/10 of South Africa's on a per capita basis, and there's certainly huge scope for growth, and Genser is part of the solution.
If you have a look at the deal, the way you've structured it, is it as a complement to existing more traditional means of financing from Genser, or is this a standalone deal?
We have a very productive and collaborative relationship with Fidelity Bank, which is a local Ghanaian bank which has lent Genser around $20 million of capital already. And what our funding does is complement the funding advanced by Fidelity. And in this sense, this I think is a good pattern for future deals in Africa, where we work very well with local African banks and provide that risk capital that they aren't able to provide.
So this is a sort of a template, if you like. This is your first deal, apart from the one that you described in Botswana earlier on, but of its type, this is the first deal that you've done. Do you believe you can go to other countries now, maybe even do it in South Africa, and say, look what we've done in Ghana with Genser, we can do exactly the same for you?
Absolutely. We're looking at several deals in Nigeria right now. We're looking at another very exciting deal in Ghana. We've got several deals going in East Africa as well. So certainly we see more than 50% of our deal flow right now, Lindsay, coming from rest of Africa.
What about the competition? Because obviously people will be watching this and saying, hello, I can do this as well, thank you. I want a slice of the action. Is it competitive out there, Luke?
It isn't right now, and that's because in some sense we are kind of the last man standing after the 2008 crisis. There was a mezzanine fund called Makalani that delisted some time back. Mez Partners, another competitor of ours, was swallowed up by Stanlib. So right now we really have the space to ourselves, but there are always new players coming along, and we don't expect the situation to last too long.
No, it will of course last a lot in the future. In other words, the type of deals that you can do, and the deal flow, I think, will continue, because on CNBC Africa we talk a lot about the potential for the African continent, and this is the sort of deal that can talk as much as we like about it, but this is the sort of deal that does reinforce that is the case. And it's very interesting, you said in your introduction, this is the first or second deal you've done outside of South Africa's borders, and that's a story that's being replicated throughout South African industry. In other words, companies going to the rest of Africa to do deals because perhaps South Africa just slowing down a little bit.
I think there's good opportunities in South Africa too, but I think in the rest of Africa these countries are playing catch up, and there's a lot to be done in the infrastructure space, in mining and resources, in the consumer space. So we're very excited about our African pipeline, and we've also invested heavily, Lindsay, in the team. We've brought on board nationals from Ghana, from Nigeria, from Kenya, from Botswana, just to give us that depth of knowledge that you need to transact successfully in these markets.
What would be your preferred area to target in Africa? Would it be ICT? Would it be FMCG? Is it going to be telecommunications, energy? Where do you see the most potential?
We're sector agnostic, so we look at many different sectors. I think what's important with mezzanine is that the cash flows be relatively predictable, and that there be good security that we can lend against. At the end of the day, mezzanine is a cash flow lending exercise. So first and foremost, the cash flows.
Where do you get the money from?
We've got a wonderful investor base of about 30 institutions, some of the leading insurance companies in South Africa, many of the leading pension funds. We've got 14 pension funds in our second fund, as well as some endowments, both here and abroad in Europe and America.
What do you offer them? I mean, because of the nature of this deal, people must be queuing up to help you fund such a deal. But what are you offering your investors?
What we say is we're going to try and achieve 80% of private equity return for 50% of the risk. So we're looking for returns that are late teens, early 20s. But then we're looking to secure ourselves, Lindsay, with security of assets, with financial covenants that the banks typically apply in order to keep their bad debts to a minimum.